I'm Deborah Borchardt, and this is your midday market update. Well, we started out in the green, and so far we have stayed there midday. We little wobbling, little negativeness for a while, but no, we are back in green territory. And I'm with Mark Newton from Greywolf. So, Mark, where's this correction everybody wanted and talked about? Because every time we kind of pull back a little bit, the buyers come right back in.
Yeah, we really held right where we needed to last week. That was a key thing. The S&P got down to right near 1,600. The Dow really near the same levels, near its 50-day moving average. The key point is that this uptrend from last November still has not been violated. And so we saw about a 3.5% correction into this level. It wasn't even a 5% correction. The last time we had 5% was back last November, I think the week following when Barack Obama was reelected. An amazing amount of volatility. Look, the last 6 out of 10 days, the Dow has seen triple-digit ranges, 2 in the last week. Prior to that, over the last 5 months, we've only seen that a total of 4 trading days alone. So it's amazing. We have seen a real pickup in volatility. Treasury yield, looking at the 10-year getting back over 2%, has been a little damaging for some of the yield-sensitive issues. You look at home builders and REITs and really the utilities and the telecoms. So you've seen really a switch out of some of the defensive sectors. Commodities continue to be under pressure, in particular emerging markets, and that's also a big deal. So that's hurt a lot of the commodities and also commodity-centric currencies when you're looking at things like the Aussie dollar and the Rand. The U.S. dollar right now has very strong correlation with U.S. stocks. Bespoke mentioned that earlier. We have about a 0.82, which over the rolling 6 months, which is really the highest levels we've seen in over 10 years. Prior to that, you mentioned, the last 10 years has been almost negative when you look at the U.S. dollar versus U.S. stocks. So the economic situation continues to sort of muddle along. We've seen a little bit of a bounce in housing, and now with interest rates starting to ratchet up, people feel that might be potentially under pressure. People that want to argue for the tapering, you're going to continue to see that. When is it going to be? Is it going to happen in September? Is it going to happen year end? My thinking is until you see real signs of growth, that is going to continue to be on the table. I think that we can't afford to taper now. At least that's probably what Bernanke will say, that it's done some good. But we haven't really seen any measurable downtick in unemployment or real growth as of now.
Is the amount of volume affecting your calls? Because I know with technical analysis, you really look at the closing price of the day, but is volume factoring in anything with your calls here?
Well, a lot of what I do factors in more end-of-day prices. When you look at daily, weekly, monthly, you have to sort of tailor your analysis based on what clients want to see. Some people are 4 to 6 weeks out in terms of what they're looking at. Other people want to know over the next few hours what people think. So it doesn't mean that technical analysis doesn't work simply because there's been a lot of volatility. If anything, it's encouraging. It's good to see the volatility. We like to see dips that you can buy into and see rallies that you can sell.
But the volume's been very light. Is that affecting your call?
I think a lot of people turned bearish probably a couple years ago, and that was simply the wrong call. And based on volume alone, that wasn't the right reason to turn bearish. It's all about price. Volume does have importance in technical analysis, obviously, but you want to see price breakouts coinciding with volume. So volume alone has been low based on a number of reasons. Companies not splitting their stocks, to some extent electronic procedures that have been put in, so a number of factors, obviously. And I think volume eventually will return, but right now, we've seen 2 of the biggest bear markets over the last 15 years, and people to some extent are still on the sidelines, so you haven't seen a real resurgence. The sentiment is uptick, but it certainly doesn't feel like 1999 or feel like really 2005, 2006 when stocks were surging and people, you saw your mailman pull up in a Lamborghini. We just haven't seen that. People feel reticent. The money's on, they're frustrated, but they're cautiously bullish. Money managers have to participate in this rally. You can't afford to be left behind. If you're positioned bearishly over the last week, the last couple of days have been very, very difficult. In 6 trading hours time, we've basically recouped 50% of the entire sell-off from late May. So it's been a real sharp move, and you have to participate in that.
All right, well, as Mark said, it has been very volatile, and just during the time that we've talked, we've seen it go red, then we've seen it go green, so we're still moving quite a bit here. Volatility, good for traders, not so good for those at-home investors. That's Mark Newton from Greywolf, and I'm Deborah Borchardt with The Street.